Good afternoon, folks. Welcome to Liberty Call for Thursday, June 9th, 2022. Hope everybody's having a great day out there. Pretty busy day for me. I had to go run some chores, so I'm sorry I'm a few minutes late. Just got back. And anyways, if it's your first time watching, give me a big old thumbs up, like, share, subscribe, all that good stuff. I'd greatly appreciate it. Not not the best day in the markets, unfortunately. It is looks pretty ugly. Again, if you've been playing along and following along, this is not surprising. So let's go ahead and jump into the numbers. The Dow Jones was down 1.94%, closed at 32,272. S&P 500 down 2.38%, closed at 4017. The NASDAQ was down 2.75%. It looks like it took the worst of everything here domestically. It's down 2.75 at 11,754. Small caps are down almost 2%. The VIX rose almost 9% today. It's currently sitting at 2609. Sea of red. So let's see here. Canada was down 1.1. Brazil down 1.18. Mexico down 1.14. Headed over to Europe. Germany down 1.71. UK down 1.54. France down 1.4. Euro stocks down 1.7. Netherlands down 1.6. Spain was down 1.49. Italy down 1.9. Switzerland down 1.26. Bright spot. Portugal only down 0.52. Let's go ahead and move on down. Let's see. The Russian exchanges were also down. The MOEX down 1.07. The RTSI down 1.52. Headed over to Asia. Looks like Japan was flat. The Nikkei was down, or I'm sorry, up 0.04. Australia down 1.42. New Zealand down 0.97. Looks like all the Chinese markets were in the red. Shanghai down 0.76. SESE component down 1.85. The China A50 down 0.96. DJ Shanghai down 0.78. And the Hang Seng down 0.66, and the Taiwan weighted came in down 0.29. So looks like just about everything. I mean, there's a few. I mean, let's see. The Turkish market was up 1.23, and that was it. So everything was in the red for today, which, not great. But again, we've got to go through. It's kind of like, again, Andy Dufresne escaping from Shawshank prison. You got to crawl through that river of poop to get out the other side. And I don't think we have any other alternatives at this point. So, all right, well, let's go ahead and read through today's market recap. S&P 500 deepens losses as growth stocks skid ahead of inflation data. The S&P 500 deepened losses on Thursday as investors remain wary. Bullish bets on stocks ahead of an inflation report that could embolden the Federal Reserve to stick with its aggressive plans to tighten monetary policy measures. Again, there's no getting around it. I don't know why all these journalists try to talk about, slowing down with the interest rates. Growth stocks continue to pile on the pressure, led by Netflix and Meta, with the latter enduring a downbeat start to life under its new ticker META. It's no longer FB. Rising Treasury yields continue to cast doubt on growth areas of the market, including big tech, as investors await inflation data due Friday that will filter into the Fed's thinking about the path of rate hikes. Quote, they need more data. The CPI for June and for July will help the Fed get real clarity as to what's going to happen with inflation, said Robert Conzo, CEO of Wealth Alliance. Economists expect that inflation rose about 0.7% in May, faster than the 0.3% in April, but price pressures is expected to remain flat for the 12 months through May at 8.3%. If the CPI continues to tick down and inflation starts to quell, then the Fed, should hold off on some future interest rate hikes, Conzo added. Quote, depending on the trajectory and how fast inflation falls, will give us more clarity on the likelihood of a recession. Stitch Fix, meanwhile, was the latest company to flag inflation pressures, with the retailer reportedly set to cut 15% of its salaried workforce, CNBC reported, citing an internal memo. Tesla gave up some gains, but dodged the broader market sell-off following UBS's upgrade from buy from neutral, citing attractive valuations. Five Below fell more than 8% after cutting full-year guidance following mixed quarterly results that missed on the top line. Financials were also in the red, paced by a decline in banks as worries about a softer economy continue to flatten the yield curve, which tends to dent net interest margin and limits the profits banks make from lending. Capital One Financial, Wells Fargo, and Bank of America Corporation were among the biggest decliners, falling more than 3%. Ugly day, ugly day. All right, so we got some jobs data that came out. U.S. weekly jobs near 5-month high. Labor market still very tight. The number of Americans filing new claims for unemployment benefits increased to the highest level in nearly 5 months last week, but that likely does not mark a material shift in labor market conditions, which remain extremely tight. The report from the Labor Department on Thursday also showed unemployment rolls remained at a more than 52-year low at the end of May, underscoring the jobs market's strength. Amid reports of companies freezing hiring or contemplating layoffs in anticipation of a recession next year, the weekly jobless claims data is being closely watched. Overall demand for labor, however, remains strong, with 11.4 million job openings at the end of April. Economists largely shrugged off last week's larger than expected rise in claims as noise. Quote, widespread difficulties in hiring are still discouraging businesses from laying off workers, but pockets of weakness have emerged among some tech startups, as well as retailers, which have felt the impact from a shift in consumer spending to goods to services, or from goods to services, said Dante D'Antonio, senior economist at Moody's. Initial claims for state unemployment benefits rose 27,000 to a seasonally adjusted 229,000 for the week ending June 4th, the highest since mid-January. Economists polled by Reuters had forecast 210,000 applications for the latest week. The data included the Memorial Day holiday, the seasonal factors that the model that governments use to strip out seasonal fluctuations from the data had expected a 21,362 drop in unadjusted claims, as hiring typically increases in summer, but with worker shortages rampant, there's limited room for big decreases, and unadjusted claims are already at very low levels. Unadjusted claims edged up 1,008 to 100,084,604 last week. There were notable increases in applications in Florida, Georgia, Pennsylvania, which had offset declines in Mississippi and Michigan. Quote, this means that recent increases in the seasonally adjusted data have occurred because the underlying levels of filings have not moved down just by as much as the seasonal factors anticipated, but not because of an actual increase in real-world levels of filing, said Daniel Silver, an economist at J.P. Morgan. Quote, we also should keep in mind that the data can be noisy from week to week, and particularly noisy around holidays like Memorial Day, end quote. Claims have been locked in a tight range since plunging to a more than 53-year low of 166,000 in March. They have tumbled from a record high of 6.137 million in April of 2020. Quote, jobless claims are unlikely to move very much more from current levels with some loosening in the labor market, or without some loosening in the labor market, said Isfar Munir, an economist at Citigroup. Quote, a return to a more normal labor market conditions would ironically be accompanied by a rise in jobless claims. The Federal Reserve, seeking to cool demand for labor without raising the unemployment rate too high to defeat inflation, is poised to deliver another 50 basis point interest rate hike next Wednesday. The U.S. Central Bank is expected to raise its policy interest rate by an additional half a percentage point in July. The Fed has hiked the overnight rate by 75 basis points since March. The government reported last Friday that non-farm payrolls increased by 390,000 jobs in May, with unemployment rate holding steady at 3.6% for the third straight month. Economists expect the jobless rate to decline in the coming months. The claims report showed the number of people receiving benefits after an initial week of aid was unchanged at 1.306 million during the week that ended May 28th. The so-called continuing claims are at levels last seen at the end of 1969. The insured unemployment rate held at a record low of 0.9% at the end of May. Quote, the insured unemployment rate suggests that the official unemployment rate will drop further, potentially closer to 3%, said Moody's Analytics D'Antonio. Job growth needs to cool to help the Fed pull off a soft landing, end quote. Again, I really don't see that soft landing happening, but, hey, anything is possible. I'm not ruling it out. All right, last article I got here for today. U.S. household wealth drops for the first time in 2 years. Not good news. U.S. household wealth declined for the first time in 2 years in the first quarter of 2022 as a drop in the stock market overwhelmed overwhelmed continued gains in home values. A Federal Reserve report on Thursday showed household net worth edged down to $149.3 trillion from a record $149.8 trillion at the end of last year. The Fed's quarterly snapshot of the national balance sheet showed. The drop was driven by a $3 trillion fall in the value of corporate equities, a plunge that has worsened in the current quarter, while real estate values climbed another $1.7 trillion. It was the first decline in household wealth since the first quarter of 2020 when the onset of the coronavirus pandemic shook financial markets and caused a short but deep recession. I don't know if you'd really call it that, but I call it more of a bear market temporarily. Still, the report showed household balance sheets overall remained healthy through the first 3 months of the year, some $32.5 trillion above pre-pandemic levels, and looked likely to continue to support strength in consumer spending in the face of high inflation. Of particular note, bank account balances rose with checkable deposits and currency rising about $210 billion to $4.47 trillion, and time and savings deposits up about $90 billion to $11.28 trillion. The added cash may help maintain consumers' outlays even as the Fed seeks to tamp down demand and slow price rises. As yet is unclear whether the net effect will be the cushion decelerating growth as the Fed raises interest rates so as to achieve the desired soft landing, or to dull the impact of high borrowing costs so much that the central bank ends up needing to push rates so far and fast that it triggers a recession. So far, the long-awaited consumer shift from buying goods to buying more services appears to have simply pushed inflation pressures over into services rather than cooled price pressures overall. Stocks have continued to weaken in the second quarter over concern of a surge in inflation to 40-year highs and whether the Fed's aggressive response to it could stall the economy. The decline suggests Americans' wealth likely took another hit from the start of April onward. So, I guess my best advice for folks right now is get out of debt if you can as quickly as possible, and have a nice little stash of necessities, food, a means to pay for things. If the grid goes down, silver coins are probably a good bet there. That's not financial advice. It's just common sense. If your money's all in the bank in digital form, if we have big problems in, the next year, never hurts to have a little bit of, cash, set aside for those emergencies. So, all right. Well, I hope everyone has a great evening. That's all I had for today. If anybody needs anything from me, please go to dsafinancialgroup.com and you can book a meeting, drop me a phone call, or just read through all the interesting stuff I have on there. So, all right. Well, hope everyone has a great night, and I'll talk to you later. Bye.